Hey folks, let's talk about something that's been making waves in the economic world. China's real estate sector and its potential to trigger financial crisis 2.0. China's real estate sector is massive. We're talking about a behemoth that contributes around 25 to 30% of the country's GDP. Compare that to the US, where real estate makes up about 15 to 18% of GDP, or the UK and France, both hovering around the same range. Even India, with its growing real estate market, only sees around 13 to 15% contribution to GDP. But here's the kicker. China's real estate sector is not just big, it's heavily indebted. The sector's debt levels are staggering, surpassing 200% of GDP. In contrast, the US has household mortgage debt at roughly 75% of GDP, while the UK is at 85%, France at 55%, and India much lower at 15 to 20%. So, why is China trying to shift its focus from real estate to domestic consumption? It's all about economic rebalancing. The recent third plenum of the 20th Central Committee of the Communist Party of China highlighted this need. The leadership is pushing for fiscal reforms, restructuring local government debt, and boosting sectors like manufacturing, technology, and innovation. Now, let's talk about the consequences if this massive real estate bubble bursts. Within the next 6 months to 2 years, we could see a financial meltdown. Picture this, a bubble burst leading to multiple banks collapsing or requiring government bailouts. Such a scenario would severely hamper China's growth, leading to an economic slowdown. Already, signs of trouble are evident. Unemployment is ticking up, there's a demand slowdown, and manufacturing is taking a hit. This domino effect impacts technology and other corporate reliance sectors, ultimately slowing down the banking industry. If the real estate sector, contributing around 30% to China's GDP, collapses, it could spell disaster for the entire Chinese economy. Falling inflation rates are another red flag, hinting at weak consumer demand. But it's not just China at risk. A slowdown in China's economy would send shockwaves across the globe. Given China's central role in international trade, investment, and supply chains, reduced demand from China could impact commodity prices, disrupt global manufacturing, and lead to declines in foreign investment and stock markets. The ripple effects could influence global currency values, inflation, and overall economic growth, especially in regions heavily tied to China's economy. Even China's ambitious Belt and Road Initiative could see reduced support, and sectors like luxury goods might suffer from decreased Chinese consumer spending. So, keep an eye on China's real estate sector, folks. The world's economic future might just hinge on it. Thanks for watching, and don't forget to like, share, and subscribe for more insights.